So, how do you make smart decisions when you just don't have all the answers? Today, we're going to dive into a really powerful mental model, one that's used everywhere from accounting all the way to high-stakes finance. It's a framework for thinking rationally when you're staring uncertainty right in the face.
Okay, let's put you in the hot seat for a second. Imagine a stock you own just drops some totally unexpected news. What do? Do you sell? Buy more? Just freeze? Your gut might be screaming one thing, right? But there is a much more structured way to handle this. And that's exactly the problem Bayesian thinking was built to solve. How do you logically and rationally update what you believe when new information smacks you in the face?
To really get a handle on how this works, we first need to pop the hood and look at the core logic. So let's explore the belief engine that powers this entire approach.
Now, this is not about guesswork or, just winging it. It's a formal process for evolving your understanding of the world. Think about it like this. Traditional probability might say, a coin has a 50% chance of landing on heads over 1,000 flips. Bayesian probability is different. It's about your confidence right now that the very next flip will be heads, and, more importantly, how that confidence should shift based on new evidence. The whole process works in this really elegant, simple, continuous loop. First, you start with a prior belief. That's just your best guess based on everything you know up to that point. Then, you get some new evidence. A new piece of data comes in. You evaluate how strong that evidence is, and finally, you combine your prior belief with that new evidence to create an updated posterior belief. And here's the really cool part. That new posterior belief, it just becomes your new prior for the next piece of evidence that comes along. It's a perpetual learning machine.
And the actual engine driving this whole loop is Bayes' theorem. Now don't worry, you don't need to be a math genius to get the idea. It's simply the formula that tells you exactly how much you should adjust your beliefs based on the strength of whatever new information you just saw.
Let's make this real. Imagine you're looking at a biotech stock, and you think its new drug has about a 25% chance of success. That's your prior belief. Then, bam, the company announces really positive phase 2 trial results. You use Bayes' theorem to weigh that new evidence, and your updated posterior belief jumps from 25% to almost 44%. You see what happened? You haven't gotten rid of the uncertainty, not at all, but you've rationally quantified it and adjusted your conviction in a super disciplined way.
And this is not just some thought experiment. This exact logic sparked a quiet revolution in a field you might not expect at all: accounting. It fundamentally changed how we look at financial data.
So, the old school view was that financial reports were a precise measurement of a company's reality, like a perfectly focused photograph. The Bayesian view completely flips that on its head. It says financial reports are actually just signals. An earnings report isn't a perfect picture of the truth. It's a noisy, imperfect piece of evidence that we have to interpret really carefully.
And let me tell you, that shift in perspective is incredibly powerful. It's not just semantics. As the accounting theorist Robert Verrecchia pointed out, if you can interpret these signals more efficiently, if you learn to think like a Bayesian, you should, in theory, be able to gain a fundamental edge in the market.
Okay, but that brings up a really critical question, doesn't it? If financial data is just a signal, how do you measure the quality of that signal? I mean, how much should you actually trust it? Well, this is where something called the likelihood function comes in. Think of it like a tool you can use to rate your sources. It helps you formally, mathematically, describe the quality of any piece of information. Is this source rock solid, like a report from a trusted agency? Or is it flimsy, like some random rumor you heard? The likelihood function quantifies that, telling you exactly how much weight that information should carry when you update your beliefs. This graph here visualizes the idea perfectly. See that really sharp peaked curve labeled D? That is a powerful, highly informative signal. It's almost proof. Now, contrast that with a flat line, curve E. That's just pure noise. Hearing it tells you absolutely nothing new, and it shouldn't change your beliefs one bit. And it gets even more nuanced and, frankly, more interesting. A likelihood function can capture really subtle traits. For example, imagine an analyst who is extremely reliable when they're reporting bad news, but maybe they get a little too optimistic when they're reporting good news. This is a real thing called conditional conservatism, and it just shows how a signal's quality can actually change depending on the situation.
So we've covered the theory, and we've seen how it applies in accounting, but let's get down to brass tacks. How does all of this translate into a direct advantage for you as an investor? Why does this actually matter when you're building a portfolio?
Well, it turns out Bayesian methods are practically tailor-made for the beautiful chaos of financial markets. They don't just give you a single number, they give you a whole range of probabilities, so they handle uncertainty naturally. They work surprisingly well, even with limited data, because you can formally include expert opinion as a starting point. And maybe most crucially, they allow your models to adapt and learn in real time as new data rolls in.
One of the most powerful applications you'll see is a technique called Bayesian model averaging. Now, instead of trying to find that one perfect predictive model, which, let's be honest, is pretty much impossible, this technique is more like polling a committee of experts. It combines the forecasts from many different models, and it gives more weight to the ones that seem more credible. This creates a much more robust forecast and reduces the risk of you being completely blindsided if your one favorite model happens to fail.
So let's bring it all together. What is the ultimate edge here? What's the big picture takeaway?
It's really important to have a balanced view. The advantages are pretty clear. It's an intuitive way to learn, it quantifies uncertainty directly, and it lets you formally include expert knowledge. But it definitely has its limitations. Your choice of a starting prior belief can be subjective, and for really complex problems, the calculations can get computationally very intensive.
Ultimately, though, the Bayesian edge isn't just about a set of formulas. It's a mindset. It's a commitment to continuous, disciplined learning, to constantly updating your map of the world as the world itself changes. And in the constantly shifting landscape of the financial markets, what could possibly be more vital for long-term success?